Hello, ladies and gentlemen. Welcome to our webinar today. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we will have a look at entry trades, filter trades, how to create a trading rule, or the so-called entry rule. Now, so far, what we spoke about the last time, let me give you a slight reminder. This was rules of position sizing. Now, when we spoke about rules of position sizing, most of all had questions mainly connected to the so-called fixed position sizing and risk-based position sizing. So far, basically because of the previous webinars that we had, the connection to our basic trainings, as far as many of you have already went through. Those particular position sizings we took because of the basic strategies that we used before. But as we move forward to more advanced strategies, those particular systems require much more flexible rules of position sizing. Therefore, we need to use all the varieties out there and to get familiar with the meanings and what are the useful and the useless sides of all of those rules. Today, however, we will mostly focus on how to filter good and bad trades in order to get an entry signal to create our entry rules, in order to imply it into our trading plan as a next step to make a sufficient so-called efficient trading plan. And as we already know, this particular trading plan will be our GPS system in the woods or in the market. So what do you guys get? Let's start with a question that I will get you closer to what the rules of positions what the rules of entry and trade filters are. The question is, what would you get if you put two individual traders side by side for about a month time, let's say, with the exact same training, the exact same trading plan? Most likely, what will result, as I've seen it so far, as I've been testing this with some of my guys here in the office, most likely what we get here is dramatically different trading results. As I kept repeating most of the time, guys, trading is highly individualistic profession. And speaking of which, two traders does not think exactly alike, or for example, they do not possess the same level of natural trading skills or intelligence or talent or intuition. When you're, for example, studying the markets, trying to develop your ability to find top quality trading signals on the charts, even after years of study, it can still be very challenging, mentally challenging, and very stressful. There is obviously plenty of variables here, and of course that influence and affect a trader's decision-making process when analyzing a chart. Finding a trading signals, ladies and gentlemen, and then execute it is not as easy as we already know. Today, we're going to talk about the main challenge in this process, and this is filtering bad signals from good signals. I'll show you on the charts. First of all, in front of you, you've got the Euro-Dollar daily chart, and why I chose the daily chart is because the tips today for filtering trades can be applied to many different trade signals on or entry triggers. However, we're focusing on a daily chart mainly because of the simplicity of the chart itself. It gives a bit more accurate signals, as we already know, but those particular signals, should I put it this way, can be implied into smaller or bigger time frames. However, my main focus on the daily chart is mostly because of the majority of traders that are paying attention to the daily chart itself. Now, let's have a little bit of insight. The probability, safe to say that you struggle with your trading decisions sometimes. You struggle to pull the trigger due to a lack of confidence. This is one of the things that are extremely important here to remember. Or struggle, for example, because you aren't sure if this is a very good signal or a bad signal. Now, knowing what to look for and what the best signal looks like is one of the main steps to increasing your chart reading skills and, of course, confidence in your trading ability. So in this session, we will discuss a simple trading signal combined with various filters that a trader may look for to enter trades. Also, you need to keep in mind, ladies and gentlemen, that signal itself could be substituted with other strategies or signals of your own choosing. As well as I already mentioned a couple of times, the way you actually pick your trades, or the way you get a clear signal for direction is mainly depends on the strategy that you actually use. In that manner, you will amplify it and, of course, input it into your trading plan. But that would be the strategy that works best for you. Now, as I mentioned, in this session, we will have a look at the most simple ways to filter trades and find good entries. Now, why am I taking the most simple way? Because, as well as it's a very famous saying, the simpler as it is, the more efficient it gets. So, I'm not trying to offend anything or anyone that is using a very fancy, filter trade signal system. It's quite important to notice, though, that the simpler it actually is, the more efficient it gets, as well as from a sustainability, because you're not only focusing to trade today or in the next 6 months, but you're actually going to trade for life. So therefore, you need to use something that is going to work in time. Or if it, for example, fails at some ways, you will just make a few minor, minor tweaks here and there in order to point it in the right direction. But if you're using something extremely complex, especially when we speak about algorithms, EAs, so on and so forth, you might need to rewrite the whole system. So the first thing that we need to notice here when we speak about trading signals is to look for a signal with a from a bounce off of a shadow of a candlestick that creates, for example, a false break of a certain support or a resistance level. That's as simple as it gets. Now, a part of this particular trading system, false and true break-off levels, I'm implying into the trading signals that I provide each and every one of the traders in the firm or the clients as well, if they, of course, qualify for this particular signal. So when we see a reversal, for example, or a rejection signal like a shadow bar with like a candlestick with a long shadow, or the so-called rejection part of the signal, clearly bouncing from a key level in the market is typically a high probability signal. When, of course, a candle signal has a shadow that bounces through a level, it also means that it creates a false break. And a false break of a level adds a lot more weight into any signal out there. A false break of a key level is a very important event, ladies and gentlemen. Not to mention that it shows that the market could not sustain itself below or above an important level. And that a move in the opposite direction is highly probable. So we can see from the example here that you see in front of you, this is, as I mentioned, the euro-dollar chart, daily chart. Let's take this support level here, for example. It's now, why is it a support level? Because after it actually bounced off from this particular level, the price retraced more than 50% up to 66% from a Fibonacci. Therefore, it's considered to be a major support level. So what we're actually looking here is to note how the shadow bounces from the surrounding price action. Now, where do we see that actually? It's over here. You can see clearly how the shadow goes through the support level, but the price remains above the level itself. Let me try to highlight this for you. Something with the program is not entirely good here, so I'm not really going to be able to point that out for you, but therefore I'm going to insert an arrow so you can see that. It's right here. Let me make it slightly bigger for you. It's over here, this shadow, particularly bounces off of this level and stays above it. A second candlestick retests the same level, closes above it, and then the price reverses. Now, in this particular example, you will see how many times the price action have actually tried to penetrate this particular level. Once it actually made this, is the confirmation that we're looking for, something that we will talk about in the following minutes. But first of all, let's talk about the high probability shadow that we're looking at this particular example. I've shrinked in a little bit the chart, but if you have to look at it this way, you know, in a full size, you will see how large this particular shadow is. A lot of those shadows, for example, ladies and gentlemen, you can note all around the charts, especially the longer the shadow is, the smaller the real body it is, the higher probability for reverse direction is. However, this is pretty much in the section of candlestick formations and chart patterns as well. So I'm not going to go too much in detail there because today's topic is quite huge compared to the one last time we spoke about rules of position sizing, based on the fact that there are only just about a handful of rules of position sizing, but we can't really put it in together with today's session. A long-tailed pin bar, or the so-called long shadow candlestick, is a high probability candle. The shadow of this candlestick is very important. It shows rejection of price. It's safe to say, generally speaking, the longer the shadow is, as I mentioned earlier a few minutes, of the candle, the more forceful the rejection of price is. This essentially means that a longer shadow candlestick is more significant than a shorted shadow candlestick, and that longer shadow helps to spring price, let's say, to bounce the price in the opposite direction. So it doesn't really necessarily mean that every long shadow candlestick works out perfectly, but certainly many of them do, and it's a high probability setup that should be stapled of any price action trader planning. So therefore, this is something that you should always have in your trading plan. So as you can note here, you can see compared to the shadows surrounding this particular candlestick, this one is the longest shadow in this particular sideways group when we don't count this one. But this is followed by the breakthrough that we will mention in a couple of minutes. First of all, the example here, as we can see, with long shadow candlestick can occur within the context of an uptrend in this case. When we see a move against the trend in particular, and then a long shadow candlestick forms, it's a good clue that the retracement is terminated and the trend will resume from this particular long shadowed candlestick. The one that we also saw here, you can see this is also a long shadow candlestick. However, this one is longer, but what we got is just a support level after this particular retracement, and we just needed to know whether the trend will actually continue from this point on, or it will be confined within a range somewhere here to here, about slightly above 600 pips of range, which continues for quite some time. Let's measure this from here to the breakthrough. That's about 79 to 80 days. So that's about 4 months, 4 trading months, let's put it this way. So as we mentioned, the most important part of finding this particular support here is that 50% retrace entry on this particular shadow here is actually the entry that we're looking at from getting when the price bounces off of this level as well, which is the upper range over here. Moving forward to see another very good example, and let's say some kind of a rule into the filter of good trades and entry conditions, is to have an example that we do not open any positions on a breakout. We need to wait for a confirmation instead. Now, why is that? Because traders often get sucked into tempting-looking breakout trades, but such as this one. A long shadow breaks through this particular zone, and you're thinking that the trend will actually reverse from here. Instead, actually, it bounces off 600 pips to the upside, and probably hitting your stop loss, or getting you unnerved if your stop loss is somewhere around this level, way above the those two couple of shadows candlesticks there. Many breakouts result in false breakout, as we see in front of us here. So while traders have no sure way to know whether any given breakout will be a genuine one or a fake out, it's a high risk trade right into a key resistance or support level. The closer a market is to a key level, the less chance it has of continuing. So this is the rule to remember here. One more time. The closer the market is to a key support or resistance level, the less chance it has of continuing. It's something that we're getting in our days with our gold charts, for example. One thing that you need to notice here is the particular group fake outs that we will mention in the next following minutes. We will scroll back forward as well as to see some more examples. So what we need to know from this part that we spoke a couple of minutes ago, do not trade on breakout before it actually happens. Instead, wait for a closer above or below the level, because you can always enter later after the breakout on the retracement. Now, let's see why. We'll just switch back into the Euro chart to see a strong bearish candle breaks through that support level, closes below it, and another strong bearish candlestick actually continues to the downside. Now, what I usually do is I do not enter in the next one here, even if it's a very big one. Now, a clear trend is going to establish, which means that you need to wait until the price gets back to that particular level or someplace close by it, which you can see here. There is another resistance level, close resembles to this one here and minor to this group of shadows, which means that somewhere around this level you can wait for a couple of days or a couple of candles depending on the chart that you're looking at. So if it's an hour chart, just a couple of hours, you're going to wait until the price gets down there and trade for 760 pips of profit for about 12, 13 candles, which is either 12 to 13 hours or days, depending on the time frame that you're looking at. The examples here is pretty much because I don't want the chart moves forward and backward all the time, refreshing. That's why I chose the daily chart, because it's much more clear. It will better resemble as what we're talking about here today. So another thing is that inside candlesticks cause a lot of false breakout scenarios like these, especially when the market is range bound and not trading, or the inside bar or candle setup is implying a counter trade breakout, like what we see, for example, in the gold chart here. This is the group one. So let me refer this as the long shadow candlestick. Works very good as a reversal after a sustained move. So when I'm actually making my trading signals, for example, they're pretty much based on this simple rule. Extremely efficient though. So basically, I prefer to wait for a couple of days or some hours, depending on the chart time frame that I'm looking at. Most of all, because of the sustainability of the market. This is the primary rule of reversal or a continuation of a trend. One aspect of long shadow candlestick can be used as a type of filter that they tend to work very well after a sustained move in one direction. Often marking important market turning points or even long-term trades in exchange, for example. Having a look at the chart in front of us, we're looking at a continuation signal after pullback to support or resistance in the trend. So once we had a uptrend here, we had a reversal down to this point, and from then on we had a choppy trade, the so-called. So we don't trade signals in tight choppy trading. Trading signals that form in the middle of thick consolidation, for example, also known as choppy trading, is usually a bad idea. Something like this, for example. You have a long bearish candlestick followed by the so-called long shadowed candle. You can see it here. That totally signals you should stay away, especially followed by choppy trading in the next few sessions. For example, as we see this consecutive candlestick consolidation for a period of time, and then the so-called inside bar forms inside this choppy trading. This is this particular doji here that you see it. The signal becomes less valid. Always wait for momentum and confirmed break of that particular choppy congression area to validate your own signal, which makes it a confirmed break that would be a close outside of that choppy trading, meaning that the next trading entry point should be somewhere below this particular low of this candlestick, which makes it somewhere around this level. Now, if you see a break through this particular level, easily the price will get down here. But as you can see, this particular support level is quite strong. So some more conservative traders would even consider entering somewhere here. I'm not that conservative. I'm more of an aggressive trader. I could allow myself a bit of a bigger risk, so therefore a few pips below this shadow I would definitely put my pending order to trigger my short position. And if it's not hit, I have nothing to lose, because nonetheless I have another opportunity. When I see the price going back above this level, I can go long and make about 600 pips of profit over here, or even much better, you can hold it for as long as it's valid. Make a few additional take profit levels. You can see this particular support is strong as well. You can take another long position from here, for example, for the long run of another 1,280 pips of profit with one lot that's close to $13,000. Let's take a look at the particular confluence, also known as this particular choppy trading. This is simply a level that has at least two supporting factors behind it. So you see, those factors might be an obvious support or resistance level with a dynamic exponential moving average level, for example, or 50% retracement and a key support and resist levels. So you see, this particular event here grants you much more information about the market than actually this single candlestick or this one gives you. Simply put, the confluence adds weight to any trade signal. Looking for a signal that forms at a confluence point in the market is one of the best filters for separating a good signal from a bad signal, ladies and gentlemen. But note, sometimes you get trade the daily chart as we are, for example, and a signal that didn't occur at an obvious confluence level would want to avoid trading 4-hour signals or 1-hour signals if you're trading on the 4-hour chart. I hope I'm making sense to you. That don't have any confluence with other supporting factors. Now, that brings me to have a look at what to avoid when we have a situation that forms on the market, or which is one of the best filters, that is likely the lack of any supporting factors or confluence. If you see a trade setup that is essentially just floating in nowhere, without anything to give weight to it, it's probably a good setup to pass on, basically not to trade it. This is even more accurate for intraday signals, for example. There's the example, as I mentioned, a 4-hour chart, for example, or 1-hour chart signals without any type of confluence behind it is usually not a high probability setup worth trading. So let's see if we can find an example such as this one. There we go. I have I have actually marked it here. Let me just terminate this particular event here. Where did we go? Should scroll a bit backwards. Yep, there we go. Instead of deleting it, I actually went forward. Now, this section here of the market is very, very important. Let me highlight this for you. This particular setup here. And why is that important? Well, it's obvious that we shouldn't even have to think too hard whether or not this particular setup is valid. Now you can see a clear uptrend here. Let's even use the trend line to confirm that. You can see a very, very, very clear trend to the upside. Well, that means that majority of traders would take action every time the market approaches that level. But what you are missing here, despite the fact that the market is trading above this key resistance level here, you have some sort of consolidation that is extremely important not to ignore. The one that we spoke about is the nowhere trading, basically the floating price, the one that is just consolidating between a very, very tight range, especially very close to a breakout point. This is the most dangerous part ever. Now, despite the fact that we have a pickup from this point on, we have a major move down. That's about 700 pips. That's way past all of your stop losses. And you will get angry because you have set up a stop loss and it got hit because it's probably sitting below here or maybe even below here. If it's below here, then your loss is much more limited. However, in this particular case, the market can get you very, very frustrated, very stressed on a situation like this, because in a couple of hours or days time, the market picks up with a very strong force up. And if your entry was above this key resistance level, you would have even made about 1,200 pips of profit. But that's the one market condition that you should always stay away. The so-called no man's land. Do not trade it. So the point of using filters, ladies and gentlemen, what is it? What is the whole point of use? Like the ones we discussed earlier, all of these examples that I gave you from this extremely simple idea of just using key support and resistance levels, false breakouts, true breakouts, so-called. The best signals will jump out of your end are so obvious that you don't even enter into the mindset of guessing and trying to convince yourself a signal is worth taking. Remember, the market will always be there, so leave any sense of urgency out of the door. You have nowhere to rush for. If you are not sure that your signal is there waiting for you to trade it, then walk away. Just have a look at another chart, another currency pair, another commodity, another index if you wish. There will be another signal tomorrow, the next hour, the next 4 hours, or the next week. What is more important here when I say all that is not to get caught up fretting over that what could have been if you have taken that particular signal, or if you have a missed opportunity from here. You see? The most important thing is if you pass on trade and it goes on to work out in your favor, learn from it. And of course, increase your knowledge from that very same situation. But don't beat yourself up or fall into the trap of believing you're missing all these great signals. Remember, even some of the worth signals can end up working out. And if you start teaching yourself with hindsight, for example, and telling yourself, oh, I should have traded that particular signal, and next time I will. But you'll you're really going to confuse the hell out of your situation, and it will end up destroying your trading career. Or, in another hand, make worthless your own trading plan, because what you do here is develop that successful trading plan, so follow it. So while you should learn from each potential missed trade, for example, you should not become emotional or worried that you're losing money because you're passing up some good setups. For example, the moment that you actually got frustrated into some bad moves on the market and that you've hit a few stop losses, you're losing that time to spot even better signals. Learning to pass on trades is part of being a trader, ladies and gentlemen, and is as you get your own filters down, like the ones we discussed earlier, you will start to develop a more refined sense of which signals are worth trading and which aren't, and that over time you will get better at this. Trust me, I've been on the market for more than 10 years, and I know frustration or beating up yourself to death because of the missed opportunities or the regret is not really worth it, because you are long here on the market. So better survive today to trade another day. One other thing is regarding to trading like a professional trader. Like the professional traders who know how to filter their trades. If you've fallen prey to think that the professional traders are trading 100 times a day, and they trading until, and they trade, for example, every day until their eyes fall out of their orbits. That's a terrible mistake to think about. Many of the guys with large wallets, large big accounts, for example, with they wait on the sidelines patiently, and they take action only when the best signal levels and trends are present on their charts. The key here is to be patient. You need to learn to think like a professional trader. Act like you are a professional trader. Be intelligent and stop using the market for entertainment and start treating this as a real business. This is how you will become the real trader. The best and most logical explanation for why you should trade less in throughout the day, because there are, for example, less good signals for any strategy or system. So think about it. The reason is a signal is high probabilities because it doesn't happen extremely often. If it did, then it would be a high probability event, wouldn't it? If you, for example, force yourself to trade all the time, you're going to take a large quantity of useless and second-rate signals. This is simply a waste of your time and money, for example. So all you need to do is filter the good trades from the bad trades. Creating a filter checklist, for example, is a good idea. for your trades. A good exercise for any trader is to create their own checklist of different filters, for example, that they use to scan the market for potential signals. During your research, you can always spot good signals, bad signals, less probability signals, high probability signals. All of this you have to describe in a sheet of paper. What is causing these higher and low probability trades? What is causing the bad probability trades? And just make that checkbook so you can always refer to all of these notes that you've made when you start forgetting things. So creating just a very quick checklist with one of these sentences describing what the filter is, and then an example or even a screenshot image of that filter under it would help you as well. So let's have a few examples of this particular situation that I mentioned, of a checklist that it might be very useful for you. For example, number one, for example, look for a signal with a long shadow candlestick, as we mentioned earlier, that creates a false break of a level. All right, this could be a very good rule for you. Watch for obvious shadows and false breaks, in this case, key levels in the market. This filter can be applied to trading the markets or to counter trend trades. You see, counter trend trading is not a bad idea, if you know what you're doing. This particular way of filtering trades, you can even catch those counter trend trades. Therefore, the continuation of the market will be much easier for you to spot. And that will help you increase your profits of that particular trend that you're following. Number two, for example, a long shadowed candlestick is high probability candle. So this should stay in your checkbook. Number three, for example, don't bet on a breakout. Wait for confirmation instead. Number four, look for continuation signal after a pullback to support a resistance level. And this is a summary of what we did so far. Number five, continuing, don't trade signals in tight, choppy trading. The one that you see in front of you, highlighted in blue. Number six, look for this blue square confluence. This is where you will know when to avoid the market. Also, we have to avoid signals that form into this particular so-called no man's land or the flying numbers. Now, why I'm saying that, ladies and gentlemen, you have to avoid this at all costs. This filter is especially important when we use 4-hour and 1-hour chart time frames. It will pretty much look the same way, but it's only a different time frame. So after I think about it, it's been more than 10 years in the market for me, and about more than 5 years teaching different traders. It's obvious for me that the number one problem for most traders is knowing how to filter a good trade from a bad trade. Now, this is pretty much the essence of trading itself. However, it's not an easy task, but it's not an impossible one. So this is like, let's say, you have taken out a revolver, just walking around shooting anything that moves. Now this is simply a suicide. You cannot do this. If you're interested in developing your ability to filter good trade signals from bad trade signals and increase your overall confidence level in pulling the trigger on quality trades instead of quantity trades, you should definitely get in touch with me, and I will personally in a more tight one-on-one session. I will show you in depth of how to filter those trades. Now, those ideas that I give you in those webinars are just the essence of what you can actually get when you're trading with us, or when you are actually in touch with me directly, so I can filter that for you. Because what I see here is about 100 people in a webinar, more than 200 to 300 questions, which I rarely manage to even attend to. Some of my colleagues are helping out with that. So it's much easier to attend one person at a time, find out what kind of trader he is, and answer all of his questions to point him in the right direction. Much easier instead of doing that 100 people at a time. So still, I am making the efforts absolutely free for those that are interested. Well, that's all for today's session. Thank you very much, guys, for joining us today. It was a very good and useful session. I hope you've been satisfied from what you've heard so far and what I've showed you. As we already went through the rules of position sizing, the entry rules. Now, the next webinar, this Friday, we will talk about the exit rules just before I take a few weeks of vacation, head down to the coast. Still, I will be at your disposal if something urgent occurs. You know how to find me. Just dial the number, my extension at the end of it, and the system at the office will connect you to my cell phone directly. That's all for today. Thank you very much for joining us. I'll see you next time. Bye-bye.